Well, it was hard to be bullish in 2009. It really was, with lots of fear. But we've seen the secular bull market that we've been in print on since the 2009-2010 period see several different fits and starts with respect to cyclical bulls and cyclical bears. We're right now in the fourth year of the most recent cyclical bull market, which the majority of the bull, Tom, has been about momentum. This year, when we wrote our year ahead piece, which had the great opportunity to talk about in January here on air, we've transitioned to an earnings-driven market. And you talked about Dell coming into before this hit, and you talk about Micron, and you talk about all these companies being rewarded for earnings. That's actually quite good. But what is not so good relative to momentum markets is that even though the market performance can, will, and should be still positive, it's usually about half the rate of a momentum market on an annual basis, and there's more volatility. What we haven't seen is the correction or pullback that we typically do see in earnings-driven markets. So we still think we're going to see some sort of a pullback. We don't like to time the market. It's very difficult to time the market. That's why we remain invested. But we would put our extra powder to work if and when we see that pullback.
So where do you put it to work? Do you put? I mean, I know what you've been calling for is a broadening, so to speak, of the U.S. equity performance, right, into maybe value or small caps. But those sectors tend to be concentrated in financials, healthcare. Some of the underperformers of the S&P, so to speak, this year. Talk to us a little bit about what you're buying when you sort of broaden out your allocation to value to small caps.
It's a great question. So as Tommy knows, I learned the business from a great gentleman by the name of William O'Neill, and he taught me how to be contrarian. And sometimes you have to think from a contrarian perspective and be where everybody else is not, number one. Number two, from a value perspective, there are inherent fundamental value properties in the market, especially within financials, but you can also buy Damien turnaround companies that are, let's say, broken growth stocks that operationally have been broken due to management changes or missteps that actually have a great platform or product. But we really think small mid cap is going to be a very exciting place the next 10 years. If you add up all the small mid cap companies in the S&P 1000 by their market cap, they all add up to being less than the market cap of Apple, which to me is quite amazing and exciting, because if you're a portfolio manager and a stock picker, you can have tracking error and beat the market. So we think ultimately that we're going to see a little bit of an earnings revision downgrade to the really big stocks. That's going to fade into the other 493 stocks in the S&P 500, which will ultimately drive more of a broadening out. Yes, that means yields will probably fall second half of the year, and we're going to have some sort of a reprieve from the conflict in the Middle East.
Brian, what do you think of international stocks? What do you think of emerging market equities? Up 23% this year.
God bless you. That's what I say. God bless you. I think it's been an amazing run. You got to think back about this, Damien. After Liberation Day and the hatred for the U.S., a lot of people left the U.S. And then they went to Canada, they went to Europe, they went to emerging markets, and they went on a big run. But currency isn't the only reason why you should buy a particular asset like that, number one. Number two, from a fundamental perspective, what are you buying? What are you buying? What do they make? What are their goods and services? And you got to be a little bit worried in terms of the quality of the service relative to the U.S.
Brian Belski with us, Humilis here, CEO, CIO. He answers the phone. He does it all.
He answers the question, Tom. He answers the question. No more shuffling around here.
For the Vikings? Did you take the big?
Listen, I'm a small business owner. No, I can't afford to watch J.J. McCarthy sit on the bench, and I can't afford that.
Okay, it's our obligatory football talk. Let's get back to the market. And you are legend for going to like these money conferences. And what I see is a blending now of speculation into investment. I know you're going to tell me keep these two separate accounts.
Yeah.
Too many people aren't. Discuss the speculators thinking they're investing, but they're not.
They're not investing. Listen, I think investing is like life, and life is like investing. You have to tell stories. You have to live with the product. You have to understand the product, and those are the stocks. So your investing portfolio should be the ones that you're going to own, the names that you know, the names you want to be in. And let's say your other side of things, let's say you put $1,000 into an account, Tommy, and that's $1,000 that you don't need to live off of. Maybe that $1,000 turns into 10, maybe it turns into 0. That's your speculative amount.
Brian, you're one of the most successful financial advisors out there. I mean, I can't even afford a financial advisor, Tom, but I have to ask this. Everybody who can afford one, they're invested in SpaceX, whatever shares somehow, like they got in early, whatever that stuff is. And, I'm looking at, your recent note and you're saying everyone is SpaceX frenzied. And then I see this headline saying they're lowering their IPO valuation target.
Did you see George Noble on this?
I did. I saw that.
I mean, how tied?
Interesting. You nailed it. Okay, Brian Belski piling on SpaceX, 277 pages. I read the pictures. Go.
I actually think this is a good thing that we're seeing this. And then you heard about Anthropic and the OpenAI. I think it's actually good that we're kind of peeling this back. You notice that the conversation and what OpenAI is talking about is much more conservative relative to what it was 6 months ago. That means they're preparing to become a public company where you actually have to tell the truth about what's going on. But we think the play on SpaceX is Tesla.
Okay, interesting. So it's not Starlink.
No, I think it's Tesla.
Interesting. I mean, I don't know. Is that really where the market is on it? I
don't think so. I mean, I think people want to believe that they want to get it for what it is, the SpaceX, and then see what happens. Our play longer term, because I try to look at a couple, 3 years. I think they're going to combine the companies.
What do you think about the wealth creation we've seen here in the U.S. and how basically what it seems like in order to keep the consumption train going, we see investors dipping into their savings, right? We just saw the data that came out on this because they're not making any more labor income. I mean, do you see that trend continuing? How far can we go for consumption to keep up the pace?
I think we can continue to go for a while, especially because the wealth creation that has been created, you have to take profits to have those profits in your account too. And we've seen a lot of longer term investors stay in the market. So the best thing that we've seen with respect to the market has been that these high net worth private wealth people have really been keeping this thing going.
Nerd Patrol, and Brian's so good he can do the nerd stuff and also talk basic as well. So let's go nerd right now. Yeah. Arnott and Cam Harvey of Duke and Rob Arnott have a spectacular effort out in the Financial Analyst Journal that takes Fama French, value and growth, and blows it up. And their research, really hyper-detailed research, is you need fewer things in your portfolio, not 1,000 stocks, 100 stocks, et cetera. And the other thing they say to really add on is either buy growth cheap, and the next best thing is growth expensive. And instead of a two-part solution, growth and value, they come up with a four-box solution. And the answer is you want to buy growth at whatever price you can do it. How growthiness is Brian Belski right now?
It's a great question. We're actually underweight the Mag 7, but our U.S. focused product is really more technology-driven, communication services-driven, more consistent growth. We like the lower standard deviation of earnings growth, meaning it's not as volatile, number one. Number two, you're really talking about GARP too. If you look at the majority of the portfolio that you just explained, it's growth at a reasonable price. And then you have to play and respect these consistent growers that actually are high quality growers that have the momentum growth in that. The other thing too is that I think the growth indices and the value indices, Tom and Damien, are actually a fallacy because you can have. The reason why value's been doing so well is because Micron's in the value index. Is Micron a value stock?
Right.
And some of these stocks have a percentage in growth and percentage in value. So again, the way that we look at it is let's just buy good value stocks.
Audible.